Welcome to the Fear and Greed Daily Interview. I'm Adam Lang. With the last of the big banks reporting their full year results this week, we now have a pretty clear picture of how the sector is travelling. Combined headline cash earnings are up 7% to $28.5 billion. But the solid result comes with a warning about inflation, interest rate rises, and the economic outlook ahead. Doug Nixon is the Oceania Banking and Capital Markets leader at EY. Doug, it's great to be with you. Welcome to Fear and Greed.
Adam, great to be speaking with you today.
Now, overall, how would you rate the health of the big banks?
Look, we are entering into a period of volatility with a very stable foundation in our financial system, thanks to some careful management post-financial crisis, as well as some very careful management through COVID. And you're right, the major banks have reported. We've got a solid set of results. There is definitely tailwinds in the system from this rate cycle increase, but as you rightly point out, a very uncertain period ahead. Combined cash earnings of $28.5 billion, up 7%. Interest rate margin down 11 basis points, but that really is a tale of two halves. We saw that trending upwards in the second half for a number of institutions. Credit impairments down by $680 million, and average return on equity of 10.6%, up about 65 basis points. But as you rightly say, Adam, the results show we're actually at a really interesting inflection point in the system. This rapid increase in cash rates has provided that boost to NIM, but the full impact of inflation and rates have not yet made their way through the financial system. And really interesting is the mixed results on operational expenses. We've definitely seen a laser focus on tight management of operational expenses across the industry, but a very, very constrained labour market and inflationary pressures have meant that expenses have actually increased year on year across the sector. So a solid set of results with some tailwinds, but the industry faces into a very volatile period ahead.
So, and just to call out NIM, that's net interest margin, right?
Yes, that's correct.
Yeah. So in amongst that, you're getting a sense that changing topography, interest rates are changing, but the skill levels having to change and the application of effort to effectively run the banks. Would that be right?
It's much tighter management now and leading into this next period. As you said earlier this week, we're entering into a really interesting period where you're having decreasing house prices, increasing interest rates, and very careful management required across the industry to manage, for example, provisions and credit losses through a period of stress in the system. But also what's happening in the background, these forces are meaning that credit markets are becoming more constrained. They're not growing in the way that they used to, which will introduce competitive pressure into the system. And we're already starting to see that, for example, in deposit markets where there's some really competitive rates starting to emerge for household deposits.
So it's a really interesting time. And as you say, that competitive topography, getting cash and loaning cash, maybe there's some things out there for consumers. If they hunt around, there are still good deals to be found.
Certainly in deposit markets now, it's early, but we've certainly seen some interesting changes happening in that market. You are seeing deposit rates of above 4% by some institutions, which we haven't seen for a very, very long time. I think we'll also start to see more competition in interest rates on credit products as well as institutions chase market share. And I think my suspicion is that households are going to become much more sensitive to differences in interest rates as home budgets become more constrained. So people are going to be shopping around to make their money go further.
That makes sense. And look, cash is king, right? But just as background, why do we talk about cash earnings?
So this is essentially, and you mentioned NIM before, the difference that institutions do make between the amount that they borrow and the amount that they lend out at. And financial institutions have to go to market to source funds to fund their portfolios. They do that typically in a couple of fashions. One is funding from households, so retail deposits, term deposits, all the products that you and I see when we place our money in a financial institution. And they also go to wholesale markets. The reason why there's so much talk about this at the moment is that all of the funding sources are getting more expensive as we're seeing fiscal policy change. Even the wholesale funding markets have been becoming more expensive for financial institutions to source funds off. And we've particularly seen that in the last couple of months as a few of the major banks have gone to wholesale markets to source funds.
Stay with me, Doug. We'll be back in a minute. I'm speaking to Doug Nixon, Oceania banking and capital markets leader at EY. So if we were looking at the data dashboard of the banks, what are the measures saying about credit impairment charges, return on equity, the average net interest margins? What are some of the key takeouts that you're seeing this time around?
Yeah, Adam, it's a great question. We've talked a little bit about NIM, and in the second half, you have to dive into the results and split apart. Most institutions report on a half-by-half basis. You really have to look at the second half because overall net interest margin is down this year, 11 basis points, but you're seeing an uptick, just the early start of the upward trend in the second half. Overall, it's still down year on year, and even if in the second half numbers, it's not back to where it was, but that's starting to creep up. So that's the benefit of rising interest rates and essentially the short-term effects of the existing pool of funds that the bank have versus what they're lending out at. The credit impairments are also down. We're not really seeing defaults make their way through the system yet as a result of house prices rising or businesses getting constrained in this environment. Most institutions in their commentary talked about that effect coming into play 12 to 24 months from now. So we might see a bit over this coming financial year or the financial year that we're in, FY23, but really manifesting in FY24. So it really is an inflection point. We're seeing these kind of early effects of this change that's happening in the economy, but we haven't seen the full impact of it, i.e. dampening of the labour market, compressing of house price, really trying to slay the inflation dragon. We haven't seen the effects of that manifest into the financials yet.
Slaying the inflation dragon is a great statement and a great quest, isn't it?
It is, and in my opinion, the right one. I mean, that's essentially what we're chasing with this interest rate policy.
So important. We seem to see data coming through more quickly now. What are the banks seeing in terms of that mortgage stress, for sale, bad debts? You mentioned that this was a game of two halves in the last year and still one to watch in the period ahead. Are there any early indications?
So there's two things you typically look at when you're trying to get a sense of this across the industry. One, you mentioned credit impairments down year on year. The other one is the provisions that the financial institutions put in place and the credit provisions they put in place. And that has been a very fascinating area to watch. We've got this layover effect from COVID where the industry put in place actually quite high credit provisions and basically the expectations of defaults rather than the defaults manifesting themselves in anticipation of the economic downturn that never really happened in COVID. And what the industry has been very effective in doing is using those provisions and carrying them over in anticipation of the defaults that are likely to manifest in market. I will, as a side note, I'm a big believer in the financial system and it being a heartbeat for this economy and every economy around the world. It is very reassuring that we have a very strong financial system entering into this period of volatility, not only in terms of provisions, but also in terms of the work that has been done to increase regulatory capital, essentially the safety buffer that these institutions have in place in the event of an economic downturn or a shock happening to the financial system, because it means that the banks have more options that they can deploy to help individual households and the economy as a whole as we enter into this period. And that is everything from being more lenient in their approach to credit defaults with individual consumers, renegotiating terms, stretching out repayments to keep the monthly repayment down, all the way to being more tolerant in this market when that volatility starts to manifest.
It's such a great tip. Whichever bank or banks you deal with, look to them as your partners and experts in this. If you've got a challenge, talk to them, right?
Yeah, and they have teams that are in place to do exactly this. They would much rather see people retain their home and rework out payment terms than have to go into a default situation. It's an unpleasant experience for everyone involved.
So costs continue to be a challenge, and they're working hard to decrease the cost base. That's not easy, though, because you've got, as you mentioned before, some of the pressures, price rises, labour market shortages, branches, legacy systems, demand for talent, regulatory impositions, cybersecurity, and I'm sure there are more, but already that's a big list. What are you seeing ahead?
Yeah, it's a very, very good question, Adam. We definitely saw an increase in operating expenses. I mean, it was a bit mixed across the market, but the general trend was an increase in operating expenses. And the narrative that came out, which I think to me makes a lot of sense, is increasing labour costs. We're in a very, very constrained labour market right now, and there have been some very public renegotiations of wages and agreements that have had to be put in place across the industry that have essentially had an inflationary pressure for the banks on the cost of wages. The vacancy rate in the sector is also very high.
As in the employee vacancy rate?
Yeah, that's right. That's right. They are searching for talent, and it's a different sort of talent than they used to as well. It's to get the institutions ready for the next generation of service offerings, for example. And there is a significant amount of spend that they need to execute on to remain competitive in the market, to uplift digital capability, to be able to decrease the amount of time it takes them to make decisions on the issuance of credit products in the market. You'll hear terms like productivity and time to yes in a lot of the earnings calls, because essentially they're very big capital expenditures to streamline process, make the customer interaction more seamless, or provide a better service to the customer via digital channels. And all of these things are going to continue to push up costs for the financial institutions in the short to mid-term. And really, until the labour market turns, I can't see that changing for any financial institution in the market. I mean, they need to spend to remain competitive, and they are subject to labour forces of the broader economy.
They're such big institutions, and it's still such a dynamic space, isn't it?
That's right. And it's changed a lot as well. I mean, the skills required 20 or 30 years ago in this space, as opposed to today, are vastly different. Much more demand on data analytics, data scientists, user access interface, UI design. And you mentioned just very briefly a very important topic at the moment. Cyber skills are in very big demand across the market as well.
Well, competitive pressure is a good thing, right? In the end, customers win. So this has got to be good for all of us. So finally, one for the investors. Now, the banks have had a good performance over the last year or so, but how do you think they've done on their shares and dividends this year?
I think it's been a good year for the industry as a whole. I won't comment on any one particular financial institution, but we've seen positive trends across the industry as a whole. I mentioned average ROE before, actually increasing quite substantially by 65 basis points. I do think, like the broader market as a whole, there is some trepidation or nervousness about what lies ahead for the next 12 to 24 months. We just are in a very, very volatile period, which means that predicting the future is a little bit harder now than it has been for a while.
Yeah. Well, look, Doug, predictions are virtually impossible, but it is a complicated market, and you've really helped us to understand it today. So thank you very much for talking to Fear and Greed.
Adam, it's been great to chat with you. Thank you for your time.
That was Doug Nixon, Oceania Banking and Capital Markets Leader at EY. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Adam Lang. Enjoy your day.